Close your eyes. It's December 17th, 2017. Bitcoin hits $19,783. In a suburb of Seoul, a 22-year-old college student checks his phone at 3 a.m. and starts crying. Not from sadness, from shock. 3 months ago, he put his entire semester's tuition into something called Ripple. It is now worth 10 times what he paid. In a San Francisco WeWork, a startup founder is refreshing Coinbase while his investors wait on a call. He has not heard a word they've said in the last 10 minutes. In suburban Ohio, a 61-year-old retired teacher has just refinanced her house to buy Ethereum. Her financial advisor does not know. Her husband does not know. Nobody can fully explain what is happening. Experts go on television and say blockchain over and over. Companies add the word blockchain to their names and their stock doubles overnight. A beverage company called Long Island Iced Tea renames itself Long Blockchain Corp. Its shares jump 200% in a single day. It feels like the future arriving all at once. It always feels that way, right before it ends. People across the globe found themselves calculating hypothetical riches. If only they had invested earlier, they mused. They would now be wealthy beyond their wildest dreams. It was a collective daydream, fueled by a belief that anyone, anywhere, could strike it rich in the brave new world of cryptocurrencies. But beneath the exhilaration, there lurked a shadow of uncertainty. How could something so intangible, so abstract, hold such colossal value? This is the story of how the world got swept up in the 2017 crypto boom and the sobering crash that followed. It's a tale of dreams and disillusionment, of fortunes made and lost in the blink of an eye. To understand this remarkable year, we must first trace the roots of the crypto revolution. We go back to 2009, a year etched into history, when Bitcoin was quietly introduced to a small community of technophiles and visionaries. Its creator, the enigmatic Satoshi Nakamoto, laid the foundation for a decentralized financial system, one that promised to bypass traditional banks and empower individuals. For years, Bitcoin lingered on the fringes of mainstream consciousness, a curiosity for some, a symbol of financial rebellion for others. By 2013, it experienced its first notable surge, peaking at $1,000 before crashing back down. Yet this was only the beginning. In 2015, Ethereum entered the scene with its revolutionary concept of smart contracts, setting the stage for a new wave of innovation. The cryptocurrency landscape was evolving rapidly, laying the groundwork for the events of 2017. As the crypto market expanded, so too did the opportunities to raise funds. The initial coin offering, or ICO, became the new gold rush. It allowed projects to bypass traditional fundraising methods, attracting millions in mere moments. In April 2017, Gnosis raised $12.5 million in just 12 minutes. The following month, the basic attention token garnered $35 million in less than 30 seconds. These staggering figures reflected a community gripped by an insatiable appetite for risk and reward. But as the year progressed, the line between innovation and speculation blurred. With every new token sale, optimism soared, yet so did the specter of volatility. Investors were swept up in a frenzy, often overlooking due diligence in their haste to join the party. As we stand on the precipice of this story, one question remains: how close to the sun can you fly before the wings of fortune begin to melt? Let us begin with Chapter 1. As we stand on the precipice of this story, one question remains: how close to the sun can you fly before the wings of fortune begin to melt? Let us begin with Chapter 1. The year was 2017, a time when the world of finance and technology collided in a frenzy of speculative fervor. Bitcoin, a digital currency created in 2009 by the mysterious pseudonymous figure Satoshi Nakamoto, had begun its ascent years earlier. At the start of 2017, Bitcoin was valued at approximately $1,000. By December, it was flirting with the $20,000 mark, an astronomical leap that left everyone from Wall Street veterans to college students in awe. But Bitcoin was not the only player in this unfolding drama. Ethereum, a platform introduced in 2015 by a then 21-year-old programmer named Vitalik Buterin, was crafting its own narrative. Ethereum introduced the world to smart contracts, self-executing contracts with the terms directly written into code. At the beginning of 2017, Ethereum was priced at about $8. By the year's end, it reached nearly $1,400, capturing the imagination of a new generation of tech enthusiasts and investors. The rise of these digital currencies marked the beginning of a tidal wave of interest in what became known as initial coin offerings, or ICOs. ICOs offered a novel way for startups to raise capital, bypassing traditional regulatory frameworks like those enforced by the Securities and Exchange Commission. This new method of fundraising was reminiscent of the dot-com boom and the crowdfunding surge that had enthralled investors in the past. Gnosis, for instance, managed to raise $12.5 million in a mere 12 minutes in April 2017. Basic Attention Token, known as BAT, achieved $35 million in under 30 seconds in May of the same year. Among the most notable ICOs was that of EOS, which began in June 2017. Over the course of 12 months, EOS raised an unprecedented $4 billion. A testament to the insatiable appetite for digital currency investments. This era was often compared to a gold rush, where seemingly ordinary people became millionaires overnight, driven by the promise of unimaginable returns. The tales of rags to riches were plentiful. Take the story of Chris Larsen, the co-founder of Ripple, for example. Ripple, with its XRP token, saw its price increase from less than 1 cent to $3.80, marking a 36,000% return in 2017 alone. This meteoric rise in value saw Larsen's wealth balloon on paper, positioning him briefly as one of the richest men in the world. For many, riding the crypto wave was not just about money, but about being part of a movement that promised to democratize finance and disrupt traditional banking systems. It was a rebellion against the status quo, fueled by a distrust in central banks and governmental monetary policies. The global financial crisis of 2008 was still fresh in many minds, and cryptocurrencies represented a new way forward, a hedge against economic uncertainty. Yet beneath the surface of this exuberance, there were signs of instability. Stories began to emerge of projects with no clear business plan, and some, with outright fraudulent intentions, took advantage of the unregulated environment to exploit uninformed investors. People's life savings were being invested in these ventures, often without due diligence, blinded by the prospects of high returns. As the year progressed, regulatory bodies around the world started to take notice. Countries like China began to crack down on ICOs, banning them outright in September 2017, a move that sent shockwaves through the community. South Korea followed with measures to regulate the frenzy, reminding investors of the inherent risks involved. Yet, the warnings were often drowned out by stories of extraordinary wealth. The media played a significant role in amplifying the mania. Headlines screamed of Bitcoin millionaires and the unprecedented returns that crypto investments were yielding. CNBC, the New York Times, and countless other outlets ran stories, each more sensational than the last, often without the necessary cautionary caveats. This media frenzy only served to draw more people into the market, sometimes with little understanding of the technology or the risks involved. As Bitcoin neared the $20,000 mark in December, the speculative bubble seemed ready to burst. The excitement reached a fever pitch, reminiscent of the tulip mania of the 17th century or the South Sea bubble of the 18th century. History has shown us that such parabolic rises are rarely sustainable, yet the hope of striking it rich kept the flame alive. Behind every chart and every price point were real human stories. Stories of people like Jamie, a school teacher from Ohio, who invested her savings hoping to secure a better future for her children. Or Miguel, a tech worker from Spain who spent sleepless nights mining Ethereum from his small apartment. These individuals, among countless others, found themselves at the mercy of a volatile market, driven by forces often beyond their comprehension. As 2017 drew to a close, the crypto world was on edge. Would the market continue its upward trajectory, or was a correction imminent? For those who had thrown caution to the wind, the stakes were high. There was a palpable tension, a sense that the party could not last forever. The year everyone got rich was also the year everyone feared losing everything. In the midst of this financial euphoria, investors were left grappling with a question as old as time itself. When would the bubble burst? The answer lay just beyond the horizon, in the shadows of the coming year. And so, as we close this chapter, we find ourselves poised on the brink of the unknown. The curtain has only just risen on this drama, and the echoes of 2017 continue to linger, setting the stage for what is yet to come. Chapter 2 awaits, ready to unravel the very foundation upon which this crypto phenomenon was built. Chapter 2 awaits, ready to unravel the very foundation upon which this crypto phenomenon was built. It all began on January 3, 2009, in a world still reeling from the financial crisis of 2008. The enigmatic figure, known only as Satoshi Nakamoto, mined the very first Bitcoin block, known as the Genesis block. Embedded within was a message. The Times 0th Jan 2009, Chancellor on brink of second bailout for banks. This cryptic message was not just a timestamp. It was a declaration of independence from traditional financial systems. The blockchain technology that underpinned Bitcoin promised transparency, decentralization, and security, a stark contrast to the opaque systems that had led to the global economic downturn. Bitcoin was not merely a currency, it was a movement. The years that followed saw Bitcoin slowly gaining recognition. On May 22, 2010, a programmer named Laszlo Hanyecz made history by purchasing 2 pizzas for 10,000 Bitcoins. This transaction, now famously known as Bitcoin Pizza Day, marked the first real-world use of Bitcoin, cementing its nascent utility in everyday transactions. At that time, those Bitcoins were worth about $41. Today, they'd be valued in the hundreds of millions. Bitcoin's journey from obscurity to prominence was not without hurdles. In 2013, Bitcoin experienced its first major surge, surpassing the $1,000 mark for the first time. This surge was driven largely by the growing distrust in traditional banking systems and the appeal of a new, decentralized form of currency. Yet this early rally was short-lived, as regulatory fears and security breaches soon led to a significant crash, bringing Bitcoin's value back down to earth. While Bitcoin struggled to regain its footing, a young programmer named Vitalik Buterin was envisioning a new frontier for blockchain technology. In late 2013, Vitalik, then just 19 years old, introduced the concept that would become Ethereum. Unlike Bitcoin, Ethereum was more than a digital currency. It was a platform for decentralized applications, utilizing smart contracts to automate and secure transactions without the need for intermediaries. Ethereum's white paper laid out a vision for a more versatile blockchain, one that could host applications from financial services to governance systems. By July 30, 2015, Ethereum's network launched, and its native currency, Ether, began trading. This innovation opened the floodgates for a new kind of fundraising, the initial coin offering, or ICO. The first major ICO was Ethereum's own token sale in 2014, which raised over $18 million. This was a pioneering moment, demonstrating the potential for blockchain projects to bypass traditional venture capital routes. This newfound method of raising capital would soon become a critical component of what many referred to as the crypto gold rush. By 2016, blockchain technology was beginning to capture the imagination of entrepreneurs and developers worldwide. One of the most ambitious projects of this era was the DAO, a decentralized autonomous organization, which aimed to create a venture capital fund without a centralized management structure. In April 2016, the DAO raised a staggering $150 million through an ICO, reflecting both the enthusiasm and the risks inherent in these new financial mechanisms. However, the dream of a decentralized future hit a major obstacle in June 2016 when a vulnerability in the DAO's code was exploited, resulting in the theft of $60 million worth of Ether. This incident not only highlighted the security challenges of the nascent technology, but also led to a controversial hard fork to recover the stolen funds, demonstrating the complexities and growing pains of blockchain governance. Despite these setbacks, the groundwork had been laid. By early 2017, the blockchain community was bustling with innovation and optimism. Bitcoin, having recovered from its previous crashes, started the year at around $1,000. Ethereum, too, was gaining momentum, its value rising from $8 in January to nearly $1,400 by year's end. The stage was set for a remarkable, albeit turbulent chapter in financial history. The nexus of innovation continued to expand as developers realized they could leverage blockchain technology for a myriad of purposes beyond currency. Smart contracts became the building blocks of decentralized applications, enabling trustless interactions and opening up endless possibilities for automation. The allure of blockchain's potential attracted not only tech enthusiasts, but also financial institutions, eager to explore its disruptive capabilities. As 2017 progressed, a pivotal shift occurred. People from all walks of life, driven by tales of newfound wealth and a desire for financial independence, rushed to invest in these digital assets. Cryptocurrencies, once the domain of tech-savvy individuals, entered the mainstream consciousness. It was a time of fervent speculation as digital currencies seemed impervious to traditional market constraints. Yet this influx of interest was not without its consequences. The ICO model, while revolutionary, became a double-edged sword. By removing traditional barriers to entry, it democratized investment opportunities, but also paved the way for unscrupulous actors. Projects like Gnosis and Basic Attention Token, which raised $12.5 million and $35 million in mere minutes, exemplified the manic pace of investment. The ease of launching an ICO meant that countless projects, some legitimate, others not, were vying for investor dollars. The ICO boom was reminiscent of past financial bubbles, characterized by rapid growth and speculative excess. By the end of 2017, thousands of ICOs had collectively raised billions. This frenzy was fueled by media hype and stories of overnight millionaires, overshadowing the inherent risks involved. The crypto market was a volatile, high-stakes environment where fortunes could be made and lost in the blink of an eye. Yet amidst the chaos, there was a sense of palpable excitement. Enthusiasts believed they were part of a revolution that could reshape the world's financial systems. The ethos of decentralization and empowerment resonated deeply, offering a glimpse of a future where individuals had greater control over their financial destinies. This utopian vision of a decentralized world drove many to invest, not just their money, but their hope into the crypto ecosystem. But with every rise comes the shadows of inevitable challenges. As 2017 drew to a close, the market's exuberance signaled that a turning point was near. Bitcoin approached $20,000, an all-time high that seemed both exhilarating and precarious. Investors, fueled by a blend of greed and optimism, continued to pour money into the market, seemingly heedless of the growing risks. As we transition into Chapter 3, the focus will shift to the ICO machine, a catalyst that propelled the market to unprecedented heights, forever altering the landscape of finance and investment. The allure of the initial coin offering, or ICO, was intoxicating. In 2017, they became a phenomenon, promising to democratize access to capital and innovation. For many, ICOs represented a new frontier in fundraising, a way to bypass traditional venture capital and its gatekeepers. The mechanism was simple, yet revolutionary. Companies issued tokens on the blockchain, which investors could purchase using established cryptocurrencies like Bitcoin or Ethereum. These tokens often promised a stake in the project or some utility within its ecosystem. It was a model that allowed for immense speed and reach. One of the earliest and most significant ICOs was Ethereum itself. In 2014, Ethereum raised $18 million, laying the groundwork for what would become the second largest cryptocurrency by market capitalization. This success story inspired countless entrepreneurs to follow suit. By 2017, ICOs had become the go-to method for raising funds in the crypto space. Notably, the DAO, or Decentralized Autonomous Organization, marked a milestone in ICO history. In April 2016, it raised $150 million, setting a precedent for the massive potential of ICOs. However, the DAO also highlighted the vulnerabilities of this new fundraising model when it was hacked weeks later. Despite such setbacks, the ICO craze only intensified in 2017. Projects like Gnosis and Basic Attention Token captured the imagination of investors. Gnosis raised $12.5 million in just 12 minutes in April 2017. The Basic Attention Token surpassed expectations by raising $35 million in under 30 seconds in May of the same year. The scale of these numbers was staggering, and it wasn't long before the media took notice. Stories of astronomical returns fueled a frenzy of speculative investment. The promise of getting in on the ground floor of the next big tech company was too tempting for many to resist. The ICO boom was part of a broader trend towards decentralization. Proponents argued that ICOs provided opportunities to fund projects that would otherwise struggle in traditional markets. Indeed, many of the ideas being funded were innovative and ambitious, ranging from decentralized storage solutions to blockchain-based prediction markets. However, with this unprecedented access to capital came an equally unprecedented lack of oversight. Unlike traditional IPOs, ICOs operated in a regulatory gray area. The Securities and Exchange Commission (SEC) had yet to issue clear guidance on how they should be regulated. This ambiguity attracted not only legitimate entrepreneurs, but also bad actors looking to take advantage of the hype. The lack of regulation meant that many ICOs were launched with little more than a white paper and a dream. Investors often had no recourse if a project failed to deliver. This environment was ripe for scams and fraud. In some cases, ICOs were little more than elaborate Ponzi schemes. The stories of those who found themselves caught in these schemes are cautionary tales of blind optimism and misplaced trust. Take the case of Centra Tech, an ICO that raised $32 million, endorsed by celebrities like Floyd Mayweather and DJ Khaled. In reality, the project was a scam, and its founders were later arrested on charges of fraud. While some investors lost everything, others profited immensely, at least on paper. For every Centra Tech, there was an Ethereum or a Neo, a project that fulfilled its promises and rewarded its early backers. Yet, these success stories were exceptions rather than the norm. The ICO craze was driven by a mix of greed, hope, and a desire to be part of something groundbreaking. This mix created an atmosphere where due diligence was often overlooked in favor of potential returns. People were investing in dreams, not tangible assets or proven business models. As the year progressed, the scale of money being poured into ICOs was astonishing. EOS, a blockchain platform that promised to be a competitor to Ethereum, raised a record $4 billion over 12 months. This was a staggering sum for a company that had yet to launch a working product. For many, ICOs represented a new era of innovation and democratization. For others, they were a symptom of an unsustainable bubble. The truth likely lay somewhere in between. As the mania reached its peak, regulators began to take notice. In July 2017, the SEC issued a report stating that digital tokens could be securities and thus subject to federal securities laws. This was a pivotal moment, signaling a shift towards greater scrutiny and oversight. The ICO boom of 2017 was both a testament to the power of blockchain technology and a cautionary tale about the risks of unregulated markets. It was a time of great innovation and equally great excess. As the year drew to a close, the cracks in the facade began to show. Projects that had promised the moon were struggling to deliver even a fraction of their goals. Investors began to realize that not all that glitters is gold. The stage was set for a reckoning. In the next chapter, we will explore the peak of the crypto market and the forces that conspired to bring about its dramatic unraveling. As 2017 dawned, a frenzy gripped the world that had not been seen since the dot-com bubble of the late 1990s. Bitcoin, the original cryptocurrency, began the year priced at approximately $1,000. By December, it would flirt with the astronomical figure of $20,000. This meteoric rise was mirrored across the broader crypto market, where Ethereum surged from $8 to nearly $1,400. To many, this was not merely a financial boom, but a gold rush of unprecedented proportions. Stories of overnight millionaires became commonplace, as people from varied backgrounds threw caution to the wind, investing in digital currencies they barely understood. In living rooms and office break rooms, conversations about blockchain technology and market speculation replaced the usual small talk. The world was enthralled, yet beneath the surface, the underpinnings of a speculative bubble were rapidly forming. The crypto phenomenon wasn't confined to financial hubs like New York or London. It reached small towns and rural areas, where people like Clara Thompson in Boise, Idaho, invested her life savings in Ethereum. Clara, a retired schoolteacher, was captivated by stories of transformative wealth and saw this as an opportunity to secure her grandchildren's futures. But the allure of immediate wealth can often cloud judgment. The crypto landscape in 2017 was a wild frontier, marked by a lack of regulatory oversight that allowed both visionaries and charlatans to thrive. Initial coin offerings, ICOs, became the fundraising method of choice, and the pace of these launched ventures was staggering. In May 2017, the Basic Attention Token, BAT, ICO raised $35 million in less than 30 seconds. Such rapid fundraising was exhilarating and spoke to the unchecked optimism of the era. Investors rarely scrutinized the technology or business plans behind these ICOs, often relying solely on glossy marketing presentations and promises of revolutionary change. One of the most talked about projects was EOS, a blockchain protocol that promised to build a decentralized operating system capable of supporting industrial-scale applications. Over a year-long ICO, EOS raised a jaw-dropping $4 billion, creating a frenzy of speculation about its potential. Yet, the question loomed, could these projects deliver on their grandiose promises? For every success story like Ethereum, there were countless failures. Scam artists proliferated, capitalizing on the absence of regulatory frameworks. This environment allowed projects with dubious merits to amass vast sums before disappearing into obscurity. The mania reached a point where people were willing to invest in projects without a concrete product, driven by the fear of missing out on the next big thing. Regulatory bodies around the world started to take notice. In September 2017, China banned ICOs and domestic cryptocurrency exchanges, sending shockwaves through the market. This was a sobering reminder that governments could intervene, and their actions could have dire consequences for investors. Despite these warnings, the desire for quick wealth often overshadowed cautionary tales. By the end of 2017, the cryptocurrency market had reached an unprecedented height. Bitcoin's approach to the $20,000 mark was symbolic of the speculative mania gripping the world. Yet, as with any bubble, the signs of an impending burst were becoming harder to ignore. Analysts who had once been bullish started voicing concerns about the sustainability of such rapid growth. Among these voices was John Smith, a seasoned financial analyst who had previously worked during the dot-com era. John's cautious warnings about the volatile nature of crypto investments were often dismissed as unnecessarily pessimistic. However, he recognized familiar patterns: irrational exuberance, overvaluation, and a lack of underlying value in many projects. The stage was set for a dramatic turn. As 2018 approached, the seeds of skepticism began to take root. Investors who had been chasing profits without a comprehensive understanding of the technology started to feel uneasy. Yet, the fear of losing out on potential gains kept them invested, even as regulatory scrutiny intensified. The bubble's unsustainable nature was becoming increasingly evident, but for those caught up in the excitement, reality had yet to fully set in. The turning point arrived suddenly. In January 2018, Bitcoin's value plummeted, triggering a domino effect across the entire cryptocurrency market. Projects that once seemed unstoppable faltered, and the hollow promises of many ICOs were exposed. The crash was brutal, wiping out billions of dollars in market value and leaving a trail of financial devastation. For Clara Thompson, the crash meant the loss of her entire investment. The financial security she had hoped for her family evaporated in a matter of weeks. Her story, while personal, was echoed by thousands who had been swept up in the mania. It was a poignant reminder of the risks inherent in speculative bubbles and the human cost of financial folly. The fallout was both immediate and far-reaching. Investors reeled from their losses, while regulatory bodies began to implement stricter controls to prevent similar occurrences in the future. Many projects that had thrived during the boom disappeared, leaving behind a landscape littered with abandoned dreams and broken promises. Yet within this turmoil lay a kernel of hope for some. The crash served as a catalyst for introspection and recalibration within the crypto community. Developers and entrepreneurs endeavored to build stronger, more sustainable projects, learning from the mistakes of their predecessors. As the dust settled, a new phase of development began. The events of 2017 and the subsequent crash reshaped the industry, creating a more mature and cautious environment. Lessons learned fueled innovation, setting the stage for future advancements in blockchain technology. The chaos of the bubble's burst marked the end of an era, but it also heralded the beginning of a new chapter. For the survivors, the crypto landscape was forever changed, yet the possibility of a brighter future remained. As they navigated the aftermath, they carried with them the knowledge that true innovation requires both boldness and restraint. And so, with a clearer vision and tempered optimism, the crypto community looked to the horizon, ready to chart a course for what came next. And so, with a clearer vision and tempered optimism, the crypto community looked to the horizon, ready to chart a course for what came next. It was December 2017. Bitcoin's meteoric rise to nearly $20,000 was still fresh in everyone's mind. Yet beneath the surface, subtle tremors were beginning to test the foundation of this digital utopia. The euphoric highs of the previous months had masked underlying issues. On forums and in chat rooms, whispers of regulatory intervention were becoming more frequent. South Korea, a significant player in the cryptocurrency market, had announced intentions to regulate or even ban certain trading activities. The frenzy of initial coin offerings, or ICOs, had drawn in billions, some $4 billion raised in 2017 alone, but many projects were struggling to live up to their lofty promises. For the community, the cracks began to show with the collapse of several high-profile ICOs. One such case was Centra Tech, co-founded by Saurabh Sam Sharma, Raymond Trapani, and Robert Farkas. They had raised $32 million with promises of a cryptocurrency debit card backed by Visa and MasterCard. In 2018, it was revealed their partnerships were fictitious, leading to arrests and a major blow to investor confidence. Elsewhere, the reality of technological limitations was setting in. Bitcoin, the pioneering cryptocurrency, struggled with scalability. Transaction times surged and fees skyrocketed, sometimes reaching upwards of $50 per transaction. Ethereum, too, faced its own challenges. The network was clogged by the sudden popularity of a game called CryptoKitties, where digital cats were bought and sold. This playful concept had led to a backlog of transactions. On January 8, 2018, the total cryptocurrency market cap hit an all-time high of $830 billion. Yet, the elation was short-lived. By February, the market had shed over $500 billion in value. This rapid decline was driven by a perfect storm of factors, including increasing regulatory scrutiny from countries like China, which outright banned ICOs, and the United States, where the SEC began to crack down on fraudulent offerings. Stories of individual losses began to emerge. Mike Caldwell, a software engineer from Utah, had been minting physical Bitcoin since 2011. As the market peaked, he watched his net worth soar, only to see it evaporate by spring. Then there was the tale of Stefan Thomas, a German-born programmer living in San Francisco, who famously lost access to his Bitcoin wallet containing 7,002 Bitcoins, valued at approximately $210 million at the peak. For many, the emotional toll was immense. Investors who had taken out loans to buy Bitcoin at its height faced financial ruin. The Reddit forums, once filled with optimistic speculation, became places of despair and regret. Anonymous users shared stories of losing life savings, and some even contemplated ending their lives. The adage, "only invest what you can afford to lose," became a grim reminder of the risks involved. But amidst the turmoil, there were lessons learned. The crash served as a wake-up call for both investors and developers. It became clear that the infrastructure of the cryptocurrency market needed significant improvements. Issues of security, scalability, and user experience took center stage. Projects began focusing more on building sustainable ecosystems rather than chasing quick profits. The regulatory landscape also shifted. Governments worldwide began crafting clearer guidelines for cryptocurrency operations. The SEC introduced measures to protect investors, targeting fraudulent ICOs and requiring projects to register their offerings. In Europe, the fifth Anti-Money Laundering Directive expanded its scope to include cryptocurrency exchanges and wallets, emphasizing the need for transparency and accountability. There was also a renewed focus on community and collaboration. Projects that had once been rivals found common ground in improving the technology. The Ethereum community, for instance, rallied around solutions like sharding and proof of stake to enhance network efficiency. Bitcoin developers debated improvements such as the Lightning Network to address scalability problems. Despite the setbacks, interest in blockchain technology persisted. Major financial institutions, which had previously viewed cryptocurrencies with skepticism, began investing in research and development. J.P. Morgan, after its CEO Jamie Dimon famously declared Bitcoin a fraud, launched its own digital token, JPM Coin, in 2019. This signaled a shift in perception and an acknowledgement of blockchain's potential. For the individuals who remained in the space, resilience became a defining characteristic. Many who had experienced the highs and lows of 2017 emerged with a deeper understanding of market cycles. They became advocates for education, emphasizing the importance of due diligence and the need to question overly ambitious claims. Personal stories of loss were shared openly, acting as cautionary tales for new entrants. As the dust settled, the notion of crypto as a get-rich-quick scheme began to fade. The focus shifted to long-term viability and real-world applications. Initiatives aimed at financial inclusion, decentralized finance, and digital identity verification gained traction, highlighting the transformative potential of blockchain technology beyond mere speculation. The legacy of the 2017 bubble, while fraught with challenges, laid the groundwork for a more mature industry. The lessons learned during the unraveling prompted a re-evaluation of priorities within the crypto community. While the promise of quick riches had drawn many in, the experience of loss forged a more cautious, yet hopeful outlook for the future. And so, as the crypto community looked back on the tumultuous times, they understood the importance of patience and perseverance. The mistakes of the past became the foundation for building a more resilient future. With renewed determination, they set out to navigate the complexities of this digital frontier, aware of both its potential and pitfalls. As they moved forward, a new question began to emerge. What would the next chapter hold for this volatile yet promising ecosystem? As they moved forward, a new question began to emerge. What would the next chapter hold for this volatile yet promising ecosystem? It was late December 2017. Bitcoin had approached an astonishing $20,000. The world had watched in awe as digital currencies seemed to have rewritten the rules of wealth creation. But as with every meteoric rise, questions about sustainability lingered in the air. The excitement was palpable, yet underneath the surface, cracks were beginning to show. By January 2018, those cracks had started to widen. It was a cold winter, both literally and metaphorically, for the myriad investors who had poured their savings into the cryptocurrency market. Regulatory scrutiny intensified almost overnight. In South Korea, a country where cryptocurrency trading had become national mania, the government announced plans to ban anonymous trading accounts. This marked the beginning of a more scrutinized environment that would sweep across borders. Investors, who had grown accustomed to exponential gains, suddenly faced an unfamiliar and unsettling reality. China, another major hub for cryptocurrency activity, took aggressive steps to curb the frenzy. In September 2017, Chinese authorities had already banned initial coin offerings, seeing them as a threat to economic stability. By early 2018, they extended their clampdown to include domestic exchanges, further stoking fears of a global regulatory crackdown. The market began to reflect these fears almost instantly. In just the first month of 2018, Bitcoin's price dropped by more than 50%, plummeting from nearly $20,000 to below $10,000. It seemed as though the air was swiftly escaping from a balloon once thought indestructible. Panic set in, and the sell-off intensified. Ethereum, the blockchain platform that had driven many of the ICOs, was not spared either. The price of Ether, Ethereum's native token, fell from nearly $1,400 in January 2018 to around $400 by April. It was a sharp decline that mirrored the panic engulfing the market. Investors who had entered the market during the highs of December were now facing significant losses. The collapse was not just a financial event, it was a deeply human one. Stories began to emerge of individuals who had been swept up in the euphoria, only to see their dreams unravel. Take the story of John, a software engineer from San Francisco. In mid-2017, John invested his life savings into a mix of Bitcoin and various ICOs, drawn by the allure of quick riches. By January 2018, half of his investment had vanished. The ripple effects were profound. Thousands of miles away, in a small town in South Korea, Lee Jin-soo, a university student, faced a similar fate. Lee had convinced his parents to invest in crypto, only to watch their savings dwindle with the market's downturn. For many, the crash was not just about money lost, it was about trust and hope shattered. The ICO market, once a bustling avenue of innovation and opportunity, became a graveyard for unfulfilled promises. Projects that had raised millions, like Tezos and Bancor, struggled with technical issues and internal conflicts. Investors grew increasingly wary, and many projects ceased to exist. The financial lifeblood that had once flowed so freely now ran dry. Amidst the chaos, regulatory bodies around the world began to take decisive action. In the United States, the Securities and Exchange Commission stepped up enforcement, targeting fraudulent ICOs and unregistered securities offerings. One notable case was the SEC's crackdown on Centra Tech, which had launched an ICO endorsed by celebrity figures, only to be charged with fraud in April 2018. Europe was not far behind. The European Central Bank issued warnings about the risks associated with cryptocurrencies, urging caution among investors. These actions, while necessary to protect consumers, contributed further to the market's fragility, sending prices into another tailspin. Yet, even as the market crumbled, it left behind a legacy of lessons that could not be ignored. The speed at which fortunes had been made and lost highlighted the volatility inherent in nascent technologies. Skeptics pointed to this as evidence that the hype had far outpaced reality. However, true believers saw it as a temporary setback in a longer journey towards financial decentralization. For those who remained in the industry, the crash was a sobering reminder of the importance of due diligence and regulation. It underscored the need for clear legal frameworks and ethical standards in a world that was still largely uncharted. Companies that survived began to focus inward, refining their technologies and building more robust infrastructures. As the dust began to settle, the market slowly started to stabilize. Bitcoin's price, while a shadow of its December high, found a new equilibrium around $6,000 by mid-2018. Investors who had seen it as a long-term store of value held firm, believing that this was merely a phase in the cryptocurrency's evolution. As the year progressed, conversations shifted from price speculation to meaningful application. Institutions that had watched the spectacle from the sidelines started to dip their toes into the world of blockchain technology. Projects that had weathered the storm began to re-emerge with renewed focus, emphasizing real-world utility over speculative promise. With time, the lessons learned from 2017 began to shape a new approach to cryptocurrency. Exchanges tightened security measures and imposed stricter compliance standards. Regulatory bodies started collaborating internationally to create cohesive policies that could foster innovation while protecting consumers. In the end, the fall of 2017 was not just a moment of financial reckoning. It was a transformative experience for an entire industry. It served as a reminder that with great promise comes great responsibility, and the path forward would require both caution and courage. As we look ahead, the stage is set for the next chapter in this ongoing saga. Though the bubble had burst, the potential of blockchain and cryptocurrency remained undeniable. The question now was not about if they would rise again, but how they would redefine the future of finance. The question now was not about if they would rise again, but how they would redefine the future of finance. The crash, as devastating as it was, served as a moment of profound reckoning for everyone involved. Investors, developers, and regulators alike were left to sift through the debris of lost fortunes and misplaced hopes. The year 2018 began with Bitcoin hovering around $13,000, a shadow of its former $20,000 glory from December 2017. In the wake of the crash, countless tales of financial ruin surfaced. Perhaps the most emblematic was that of John Stanton, a software engineer from San Francisco. John had invested his life savings into various cryptocurrencies, lured by stories of overnight millionaires. By January 2018, he had watched over half of his investment evaporate in the relentless slide downward. The sentiment among many like John was one of betrayal. They felt misled by the euphoria that had gripped the market and the promises of influencers who touted digital currencies as the future. Financial forums were flooded with stories of regret and desperation, as individuals sought solace and advice. For some, like Anna Ward, a graphic designer from Toronto, the crash translated to a delayed retirement, as her modest portfolio was nearly wiped out. She recalled the promise she made to herself in late 2017 to cash out once Bitcoin hit $25,000. That day never came. Companies that had thrived during the boom now faced existential threats. Many startups that had raised millions through initial coin offerings, ICOs, were unable to deliver on their promises. The SEC began to crack down on fraudulent activities, with high-profile cases like BitConnect, which was accused of running a Ponzi scheme. The situation was compounded by the absence of coherent regulation during the boom, leading to a chaotic scramble for accountability in the aftermath. In 2018, the SEC charged two ICOs, Paragon Coin and AirFox, with selling unregistered securities. Each company settled for a $250,000 fine, a regulatory shot across the bow warning the burgeoning industry. The message was clear. The era of Wild West speculation was over. Regulators were no longer bystanders in this digital revolution. The ripple effects of the crash extended far beyond financial losses. Projects that had genuine potential for innovation were tarnished by association. The crash prompted many to question whether the underlying technology, blockchain, could ever shed its speculative image and prove its worth. Ethereum, the second largest cryptocurrency by market capitalization, saw its value plummet from nearly $1,400 to less than $400 by April 2018. The platform's founder, Vitalik Buterin, took to social media to urge restraint and reflection among investors. He advocated for focus on the technology's potential to create decentralized applications rather than mere speculation. His words were a call to rebuild, to shift focus from short-term gains to long-term sustainability. Despite the turmoil, not all stories were of defeat. A subset of investors and developers saw the crash as an opportunity to strengthen the ecosystem. Those who remained saw a chance to address the weaknesses that had been exposed. The aftermath became a crucible for innovation, as the community pivoted towards creating robust technologies that could withstand future upheavals. A key part of this rebuilding effort involved educating a new wave of developers and investors. Conferences and meetups, previously dominated by talk of quick profits, began to focus on the importance of security, scalability, and real-world applications. Initiatives like the Blockchain for Social Good movement began to gain traction, highlighting uses for blockchain technology in areas like supply chain management and identity verification. The dramatic rise and fall of Ripple, XRP, was another focal point. Its meteoric ascent from less than $1 to $3.80 was emblematic of the speculative frenzy. By mid-2018, Ripple was trading at under 50, a startling reminder of the market's volatility. But Ripple Labs pushed forward, focusing on the practical applications of its technology in cross-border payments. This pivot exemplified the broader industry shift toward utility over speculation. In the legal realm, conversations began to focus on creating a balanced regulatory framework that could foster innovation while protecting investors. Jurisdictions like Malta positioned themselves as blockchain-friendly environments, promoting regulatory clarity to attract responsible innovation. Meanwhile, in the United States, debates raged over how to classify cryptocurrencies. Were they securities, commodities, or something entirely new? For individuals like Hester Pierce, a commissioner at the SEC, the challenge was to craft regulations that would not stifle innovation. Her advocacy for a regulatory safe harbor for startups illustrated the ongoing tension between regulation and innovation. Yet she represented hope for those who believed in the transformative power of blockchain technology. Globally, the crash prompted reflection not just on cryptocurrencies, but on the broader fintech ecosystem. Central banks and financial institutions, once dismissive of digital currencies, began to explore their potential seriously. the People's Bank of China accelerated its development of a digital yuan, recognizing the geopolitical implications of digital currencies. In Europe, the European Central Bank initiated discussions on a digital euro, acknowledging the shift toward digital finance. These initiatives signaled a broader acceptance of digital currencies as a component of the future financial landscape. The fallout from the crash also highlighted the importance of investor education. Many realized that their understanding of the technological and financial nuances was superficial at best. This gap in knowledge underscored the need for comprehensive education in financial literacy, particularly as digital currencies continued to evolve. As 2018 progressed, the cryptocurrency market slowly began to stabilize. Bitcoin found a floor around $6,000 for much of the year as the market matured and speculation waned. By the end of the year, the community had begun to coalesce around a vision of resilience and sustainability, rather than unchecked growth. Those who remained saw themselves not just as participants in a market, but as stewards of a technological movement with the potential to redefine the world. And so, the stage was set for the next act in the cryptocurrency saga. Lessons learned from the 2017 bubble would shape the strategies and mindsets of a new era of digital finance pioneers. As we turn the page to the next chapter, the legacy of 2017 looms large. The industry, now bruised but wiser, stands at the precipice of revolution. The question is no longer merely about survival. Now, as we look toward the future, we ask ourselves, how will this technology truly change the world? Now, as we look toward the future, we ask ourselves, how will this technology truly change the world? The legacy of the 2017 crypto bubble is not just a tale of unprecedented gains and staggering losses, but also one of profound introspection and transformation. It was a year that fundamentally altered the discourse around digital currencies and forced both enthusiasts and regulators to confront its potential and pitfalls. To truly understand the impact, we must start with the people who lived it. Consider Alex Thompson, a software engineer from San Francisco. In January 2017, Alex decided to invest $5,000 in Ethereum, which at that time was priced around $8. By the year's end, with Ethereum nearing $1,400, his small investment had grown astronomically. On paper, Alex was wealthy. Yet as 2018 dawned, the market began to retract, and paper gains quickly evaporated. This story of rise and fall was not unique to Alex. Across the globe, thousands experienced similar fates. The promise of untold wealth brought in droves of amateur investors, each hoping to catch the next wave. Yet, as history has shown, bubbles are defined by their inevitable bursts. The psychological toll of sudden loss cannot be understated. It was a paradigm shift, both personally and professionally, for many who ventured into the uncharted waters of cryptocurrency. The sheer speed of the market's ascent and descent in 2017 brought about a period of intense scrutiny and reflection. Regulators, long cautious of digital currencies, suddenly found themselves at the forefront of a financial revolution. In September 2017, China took bold measures by banning initial coin offerings, ICOs, and shutting down domestic exchanges. These actions signaled a shift in how governments perceive the threat and potential of cryptocurrencies. In the United States, the Securities and Exchange Commission, SEC, took tentative steps towards regulation. SEC Chairman Jay Clayton, in December 2017, publicly acknowledged the regulatory challenges posed by ICOs. By considering them securities, the SEC underscored the need for compliance with existing laws. This move was pivotal, marking the beginning of a more structured approach to digital finance. Beyond regulation, the 2017 bubble prompted technological introspection within the crypto community itself. Developers and innovators began questioning the sustainability of existing systems. The scalability issues faced by Bitcoin and Ethereum during the peak highlighted the need for improved infrastructure. Transactions that once took minutes were now taking hours, sometimes days. It was clear that for cryptocurrencies to achieve mass adoption, major technological advancements were necessary. This introspection spurred innovation. Projects like Ethereum 2.0 and the Lightning Network for Bitcoin aimed to address these very concerns. Ethereum's transition towards a proof-of-stake system promised increased efficiency and reduced energy consumption. Meanwhile, the Lightning Network aimed to make Bitcoin transactions faster and cheaper, addressing one of the most significant hurdles to its widespread use. The bubble also shone a light on the importance of trust and credibility in the digital currency space. Scams and fraudulent ICOs were rampant during the boom, eroding trust in the industry. The case of BitConnect, which promised guaranteed returns, ended in disaster. By January 2018, BitConnect had collapsed, leaving investors with substantial losses. These incidents underscored the importance of due diligence and transparency in a largely unregulated market. For many, the 2017 experience was a harsh lesson in the realities of speculative investment. Stories abound of those who mortgaged homes or emptied savings, lured by the promise of quick riches. As the market correction took hold, the emotional and financial toll on these investors became starkly apparent. It was a reminder that while innovation brings opportunity, it also carries risk. The bubble forced a re-evaluation of the narrative surrounding digital currencies. No longer were they merely a shadowy alternative to traditional finance. Instead, they emerged as a potential cornerstone of future financial systems. Institutions began to take notice. In December 2017, the Chicago Board Options Exchange, CBOE, launched Bitcoin futures, marking the entry of cryptocurrencies into mainstream financial markets. The aftershocks of 2017 also catalyzed increased collaboration between tech innovators and regulatory bodies. Governments, once wary of cryptocurrencies, started exploring their own digital currencies. China, in particular, accelerated its efforts to develop a digital yuan. This was not just a response to the volatile nature of cryptocurrencies, but also an acknowledgement of the potential benefits of digital currency adoption. On the global stage, the narrative shifted. Cryptocurrencies were no longer seen as a fleeting trend, but a technological evolution demanding serious consideration. This newfound respectability, however, came with increased scrutiny. International bodies like the Financial Action Task Force, FATF, began developing guidelines for digital currencies, emphasizing the need for anti-money laundering measures. For participants in the 2017 bubble, the experience was transformative. Those who remained in the space committed to building a better, more sustainable system. The lessons learned from the exuberance and subsequent fallout became the foundation for future growth. It was a time of rebuilding, not just financially, but in understanding the true potential of what digital currencies could offer. As we look toward the horizon, the question remains, how will these technologies shape the future? The legacy of 2017 is not one of mere speculation, but of profound change. It marked a turning point, a moment when digital currencies transitioned from the periphery to the mainstream. The road ahead is shaped by the lessons of the past, guiding us toward a future where digital finance is integral to our global economy. And so, the stage is set for the next chapter, where we explore the continued evolution of cryptocurrency and its impact on the world. Join us as we delve deeper into the stories of those who dared to imagine and those who continue to innovate. Join us as we delve deeper into the stories of those who dared to imagine and those who continue to innovate. The year was 2017, and the cryptocurrency market was at its most volatile yet electric moment. From Bitcoin beginning the year at approximately $1,000 and soaring to nearly $20,000 by December, to Ethereum's dramatic increase from $8 to almost $1,400, The numbers alone tell a story of frenzy. Yet beneath this whirlwind of financial spectacle lies a tapestry of human ambition, innovation, and the quest for something beyond mere profit. The crypto bubble of 2017 was not merely about digital currencies appreciating in value. It was a reflection of humanity's eternal pursuit of transformation, of reshaping the very fabric of finance, and by extension, society itself. One cannot overlook the figures like Vitalik Buterin, the young prodigy who envisioned Ethereum as the world's decentralized computer. His dream was to create a platform where smart contracts could automate and streamline countless processes, reducing inefficiencies in areas as diverse as real estate transactions to supply chain logistics. Ethereum's introduction of smart contracts in 2015 laid the groundwork for the decentralized applications that underpinned many ICOs in 2017. By offering a new way to raise funds, these ICOs democratized access to capital and allowed startups to bypass traditional venture capital routes. While some entrepreneurs held grand visions, others saw an opportunity to exploit the exuberance. Projects like Gnosis, which raised $12.5 million in just 12 minutes, and Basic Attention Token's $35 million in under 30 seconds, showcased the fever pitch of optimism and trust placed in these ventures. The ICO boom mirrored past speculative bubbles, from the South Sea bubble of the 18th century to the dot-com crash at the turn of the millennium, where the allure of new technology tempted many into irrational exuberance. Investors were drawn not only by the potential for financial gain, but by the allure of participating in a financial revolution. This era was marked by both brilliance and folly, where the lines between legitimate innovation and mere speculation blurred. Yet, what followed the exuberant rise was inevitable, an unraveling. As regulatory bodies like the U.S. Securities and Exchange Commission began to scrutinize these new financial products in early 2018, the market correction was swift and severe. The values of cryptocurrencies plummeted, leaving many investors with substantial losses. The crash, however, was not just a financial reckoning, but a moment of introspection for the crypto community. The aftermath revealed hard truths about the nascent industry. It underscored the need for clearer regulations to protect investors, yet it also highlighted the resilience and adaptability embedded in the crypto ecosystem. For every failed ICO, there were lessons learned and redirection toward more sustainable models of digital finance. Projects that survived carried forward innovations that would inform future developments, refining technologies to better serve their intended purposes. Regulators began to craft frameworks that balanced innovation with consumer protection. They understood that while the speculative frenzy had cooled, the underlying technology harbored transformative potential. Countries like Switzerland embraced the blockchain revolution by establishing Crypto Valley in Zug, positioning itself as a global hub for blockchain development and innovation. The crash also acted as a litmus test for Bitcoin and other cryptocurrencies as stores of value. Despite sharp price declines, Bitcoin's core promise as a decentralized, immutable ledger remained intact. Its resilience through the storm reinforced its status as digital gold, a safe haven in times of economic uncertainty. For individual investors who navigated the 2017 bubble, the experience was both a financial and philosophical education. Many found themselves grappling with the volatility of such emerging markets and questioned their risk tolerance. Some moved away, disillusioned by the losses, while others doubled down, convinced of the potential for a decentralized future. The legacy of the 2017 crypto bubble is multifaceted. It is a story of overreach, but also of progress. It forced a shift from speculative mania to a more mature engagement with blockchain technology. In this period of reflection, the industry has seen the rise of decentralized finance, or DeFi, which uses blockchain technology to recreate and improve upon traditional financial systems. Decentralized finance platforms, unlike their predecessors from 2017, focus on eliminating intermediaries in financial transactions, allowing users to lend, borrow, and trade directly. This new wave of innovation is more accessible and transparent, encouraging a broader participation in financial services globally. Meanwhile, the legacy of 2017 also paved the way for more stable financial instruments within the crypto space, such as stablecoins. These digital currencies are pegged to traditional assets like the US dollar, providing a less volatile option for users and helping bridge the traditional and digital financial worlds. The lessons learned from the 2017 bubble have also shaped how new projects are evaluated. Investors now demand greater transparency, clearer roadmaps, and more concrete use cases before engaging with new ventures. This has led to a healthier, more sustainable growth of the crypto ecosystem post-2017. Technological advancements continue at a breathtaking pace as developers build upon the failures and successes of the past. The crypto winter that followed the 2017 bubble sparked a renewed focus on long-term innovation rather than short-term gains. This period has seen the emergence of Layer 2 solutions aimed at scaling blockchains and the introduction of proof-of-stake consensus mechanisms that promise to make blockchain networks more energy efficient. As the dust settled, a more robust foundation was laid, supporting the next wave of blockchain adoption across industries. The narrative that began with the 2017 bubble continues to evolve, with new players entering the scene, driven by a vision for a decentralized future. The story of 2017 is not just about financial peaks and troughs, but about the enduring spirit of human ingenuity. It underscores a drive to innovate and disrupt established norms, challenging the status quo. This legacy serves as a reminder that every speculative bubble, every crash, holds within it the seeds of transformation. As we look towards the future, the lessons of 2017 remain ever relevant. They guide the ongoing evolution of digital finance, pushing the boundaries of what is possible. Join us in the next chapter as we explore the new wave of innovations that promise to reshape the landscape of finance once more. In the turbulent sea of 2017, the cryptocurrency wave carried countless dreams to new heights. Around the world, from small towns to sprawling metropolises, individuals eagerly rode the surge, their eyes gleaming with the promise of instant wealth. It was a moment when technology seemed to blur the lines between possible and impossible, bridging the gap between visionary ideas and everyday lives. Yet, as with any wave, the crest is fleeting. Soon, the reality of risk and volatility came crashing down. What does this story tell us about human nature? Perhaps that our quest for prosperity, while ambitious, often blinds us to the lessons of history. The allure of quick riches can cloak the inherent instability of uncharted innovation. In the eye of the storm, it's easy to forget the ground rules of caution and rely unwisely on whispers of invincibility. Money has always held the power to enchant and ensnare. In this digital age, technology magnifies that allure exponentially. The crypto bubble of 2017 revealed the fragility of trust in intangible assets, highlighting both the potential and peril of our technological leaps. In a decentralized world where anonymity reigns, the safeguards of traditional finance are often absent, leaving individuals vulnerable to their own optimism. The aftermath of this financial whirlwind serves as a sober reminder that every innovation carries a dual edge. While some found despair in losses, others took solace in the knowledge gained. The experience became a crucible for technological advancements, teaching the community to build stronger, more resilient foundations for the future. As we drift from the echoes of this story, let us hold on to its lessons. Trust is a fragile currency, and in the realm of digital finance, it must be earned with diligence and care. The legacy of 2017 is not in the fortunes made or lost, but in the indelible imprint left on the course of economic evolution. As you lay your head to rest, let your thoughts be gentle. Consider the possibilities that lie ahead, yet anchored in the wisdom drawn from the past. Embrace the quiet and let the calm enfold you, as night whispers you into a peaceful slumber.